So for those of you who haven't been here all day, we've got Adam Braggs here from Crowdnetic, Nicola Horlick from Money & Co, Angus Dent from Archover and Moneyco are both crowd lenders. Then we've got James Codling from Venture Founders, an equity crowdfunding platform. We have Harriet Green here from CityAM, a journalist who's got a great interest in this sector. And then last but not least, we've got David Salomons here from Cubism Law, who many of you will have heard him speak earlier today. So we'll try and crack through as many topics as we can. We'll have participation from you, of course, from the crowd. But let's kick off with, I guess, the big subject of debt versus equity. You know, what are the advantages both for entrepreneurs? Which road should they go down? And what are the pros and cons for investors? Which path should they go down? So why don't we kick off? Let's kick off with James and see what you've got to say, maybe from an entrepreneur's perspective.
Well, it depends, doesn't it? Some businesses are right for debt, some businesses are right for equity. I mean, cash flow generating businesses, profitable businesses clearly can support debt. More start-up-y, earlier stage businesses which, you know, pre-profit, need capital for growth, need longer term financing, need equity. I mean, there's no magic there. That's been the way forever and a day. We can come on to talk about this. I think there is a concern that I have in some parts of the market that debt is being, well, equity is being dressed up as debt. We can possibly come on to talk about that at some point in time.
Well, let's talk about it now.
Yeah, okay. Well, I think, you know, certainly that the lines shouldn't be blurred. I think, you know, it becomes, there is a right point in the life cycle of business when it is right to take on debt. There's some products that have evolved in the alternative finance space, cash coupon, or cash paying coupon debt instruments that really, when you look at the risk profile of those companies, they're not suitable for taking on debt. I'm talking more about the mini bond space.
I was about to say, is that these are sold to retail investors as mini bonds?
And when you look at every single dynamic of those companies and how they operate, they certainly shouldn't be taking on leverage, certainly in my opinion anyway. But I think, you know, for anybody that studies investment, everyone that knows about investing, I think it's very clear whether a company is capable of supporting debt or should be taking on equity. I mean, they're different instruments, they have different purposes, they have very different places in the world. I think as an investor you need to be smart and need to be able to understand and analyse whether that company is issuing the right type of instrument for you to invest in. Yeah, that's where we try and actually cut that out by making sure the businesses that we're supporting, you know, are right for taking on our product, which is equity.
I mean, the mini bond thing seems to have died down a bit. I remember Chilango, a young restaurant chain, and they were getting finance. I don't think they were profitable, and they were paying out 8% interest rate, and that didn't seem a very attractive investment. Nicola, do you have anything to add on what James was saying?
Well, I completely agree with James. I think it's dangerous for relatively young companies to take on debt, and they shouldn't be encouraged to do so. And we make it very clear on our side that we need 3 years of filed accounts, the company needs to be profitable, and they can only borrow twice EBITDA. And that counts out most of the people who would normally be applying for those types of loans, and we're very, very strict about that. Yeah, the mini bond thing has been interesting. I thought the best one was the Hotel Chocolat one, where you could elect to have your interest either in chocolate or cash.
But there are some good mini bonds. It's just, I mean, when you look at there's been a handful of mini bonds which have been done. Sports clubs use them to great effect, right? But they are cash generative.
Well, the Jockey Club, they have.
Well, that's not. Yeah, but people like, you know, some of the cricket clubs, some of the football clubs, rugby clubs. Maybe they are right for debt, but.
Well, I think there's an element there of somebody loving the sport, and they don't. You know, it's almost like they don't really care whether they get the money back because they love that club so much, which is different.
With the heart, not
with the heart, yeah.
David, do you have at the end any thoughts on the legal angle on debt versus equity?
Well, I do. I think they're very different things. I think debt is much more easily understandable at the moment. An investor doesn't have to be so sophisticated. It's quite simple. You put the money in, you get the money back. Hopefully it all works. To do equity, you have to understand how articles, how a corporate background works. And also, the worst thing, of course, is there's no actual exit plan on day one. You can't trade those shares. So it's a much more sophisticated thing. Having said that, I think it's very exciting. And I think if we were to look 5 years hence from now, And we might find a tradable market. There might be a Crowdkey, we're actually talking at the moment about doing a tradable market. If there was a way of trading and there'd be more standardisation of the kind of offerings, I think there's a long, long way to go for equity. I really do. And I think it's a lot better for a lot of small companies to do equity than actually load themselves up with debt.
Interesting. Does anyone else on the panel want to add? This gentleman there with his hand up. Yeah.
I find it quite interesting talking about debt. One of the funny things is a private company, especially if it's closely held by family or whatever, it's always interesting that you pay your accountant based upon how little profit you show to the tax man. Yeah, that's absolutely of no use to a lending source. So you kind of have that, you're caught between that double-edged sword between, how much can I show?
If you've got good accounts receivable, we can sell it.
I should have said earlier, please do stick up your hand at any point if you think there's something you want to add. We don't have a lot of time. Why don't we move on to valuations? I know there was a lot of talk about valuations, especially this morning. And a lot of people are arguing, especially with equity crowdfunding, that some of the valuations are very high, and so not very good businesses are able to raise a lot of money, and perhaps they don't really deserve those kind of valuations. Is this a concern that Harriet, do you have any? Are you worried valuations may be too high, or you're not too concerned on this one?
I'm not too concerned about it, provided there are enough people telling investors to watch out for valuations that could be too high.
Good answer. I like that.
There have been some that were too high, and it became quite obvious quite quickly that they were sky high, and we need to be slightly careful of companies having their own platforms and doing their own thing. That's part of my job as a journalist to try and inform people what to look out for there. But it's too early to say whether a valuation has been really damaging, because we're not that far into the journey yet. We need to give it a couple more years.
I mean, do we think the crowd actually might get more sophisticated as the years go by, and so valuations may become more accurate as the market matures? I mean, do you have any thoughts on this, Adam?
We collect valuation data from most of the equity crowdfunding platforms. Are the crowd going to get more sophisticated? Hard to say. I think the services and the information available to the crowd will become more sophisticated in terms of people adding ratings and analysis to core data such as that provided by Crowdnetic, and that will probably help people make more informed investment decisions.
Any other thoughts on this?
I think you've got to remember that equity has the benefit of tax breaks, and if it's an SDIS raise, somebody's getting half the money back from the government, and if they lose it all, they can offset it against high rate tax. And if they hold it for 3 years and then make a massive gain, it's tax free. So it's not as easy as it sounds trying to work out what a valuation should be, and it gives the company more leeway to charge more, give away less of the company at the outset, because they know that those investors are getting extremely substantial tax breaks.
Just one point on that. I think, in my experience talking to companies who are going to crowdfund, they themselves often don't know what they should be valuing themselves at. And they're actually often being advised by the crowdfunding platforms, which is interesting because the crowdfunding platforms are regulated, but the companies aren't. So I think the future's got to be a standardised valuation by a panel of companies, if you like, a panel of valuers. And that's how you get it through.
James, you're the only well, I know you don't really like to be called an equity crowdfunder, but you're the closest we've got to an equity crowdfunder on this platform. What do you think?
Well, valuation is everything, right? I mean, your return is based on the entry price that you went in at. You're inevitably going to hopefully exit at some kind of multiple of profit and a valuation, and it's the difference between the two. So if you went in at the inappropriate valuation at the start, then clearly your return is going to be hampered going down the line. I think, the thing that concerns me is that actually the crowd are slightly uneducated about this space. It is very early stage, that because there's that kind of, because the platforms haven't been set up by investment people, it's very difficult to judge what is right. Most of the platforms are led in the kind of dragon's den model of the company sets the terms. Now, nobody in the market has ever operated like that until this transformation has happened. And I think, only time will tell. It will be certainly 3-4 years before it shakes out as to whether these valuations are appropriate. everyone hopes that they are and they're going to make a return. But I think it's only, as I said earlier, until platforms start to demonstrate a track record that you will be able to say, okay, well, that is a good crowdfunding platform. I should have invested with those guys. Those guys weren't so great. They allowed valuations on there, and look, I only got a single-digit return putting my investments through them. I mean, it's such an early-stage industry, but I suspect, fundamentally because I wouldn't put my own money into those deals, that some of these valuations are massively overheated.
You say, yeah.
Yeah, I wonder whether the discussion about valuation is the correct discussion at this stage of the game. Isn't the discussion to be had is whether the platforms can create a dynamic that allows for a better assessment of, let's say, a binary decision, which is, does this deal make sense? Yes, no. And the valuation is a slightly different point, because I think the majority of catastrophes are not whether you make 2, 3, or 4, or 1 time your money, it's whether you get your money back in the first place. So it's the question I'm asking is whether, doesn't the debate have to go towards how can one make sure that the, let's say, the failure rate is comparable to other environments and doesn't sort of skyrocket, which gets back to the question of the wisdom of the crowd. Are the crowds, at the end of the day, actually intelligent in picking the deals that do make sense versus, irrespective of what the valuation is, and just let the others by the wayside?
And you say?
I think just following up on that point, the analysis done in the US by, I don't know who, and here by Nestor and Cambridge University, reveals that the average age of equity crowdfunders is quite high. And because there are lots of them, the assumption is amongst the crowd, there probably are quite a few who are genuinely doing that analysis and genuinely coming in and making opinions on the strategy of the company, of its products or services. And there are plenty of stories around where companies have slightly evolved during that campaign because the crowd has come in with real value-added commentary as to whether the packaging is correct or that the target audience is quite right, and the campaign has slightly evolved. So I think it'll be interesting to look back and see whether, whereas the traditional equity underwriting relies on a handful of analysts, a handful of financial institutions maybe doing a good job, against tens or even hundreds of probably former analysts sitting at home over the weekend with a classical music, nice glass of wine, comfy chair, in their own time doing the analysis and having the opportunity to interact with the company and say, can I ask this awkward question, which everybody sees and the company has to respond to. It's a different process, and I think it's too early to see whether it's a better process.
But this investing is no different to angel investing, right? Every single angel investor knows that you build up a portfolio of 10, 2 of them will go probably quite well and you'll make quite a lot of money out of them. A few of them will just not do a huge amount, then there'll be a bunch of failures. You have to diversify and you have to price risk accordingly. And I come back to the point I made earlier, is it right to price risk at kind of single-digit return when that company's got to hit every single number in its business plan and the higher end of its valuation multiple range before you make 10% plus? I think that's wrong. For equity investment, that's not right.
Some of the companies have argued that by going down this route, the company has benefited not just through getting some equity, but also by creating a whole body of advocates for the company. So Brewdog and Hotel Chocolat both believe that their businesses benefited hugely by having well-informed, wealthy people as investors with relatively small amounts of money invested, but who would go out there and tell people about that company.
Absolutely. Yeah.
In some ways, it's very similar to brand licensing, where you might license your brand with no hope of making much of royalties, but you're extending your core brand out there amongst more people. I think it's a really good point. And I actually like the idea of following a football club, because actually a football club would be a great crowdfunding, because people would buy into it, whatever they did, and that would take it forward. I think that there really is much more of a story when it comes to equity crowdfunding. People do follow the story. Obviously, it has to stack up. The financials have to stack up. It's not as simple. I don't think it's simple as AIM. I don't think it's quite so simple. I think there's a, as you say, brand ambassadors. The way that it's done is slightly different. Yeah. And we'll see how it pans out.
No, absolutely.
Yeah. Did you want to say something, Harry?
Well, I just pick up on a few things. What we don't have yet is any metadata around users across platforms.